welcome to NDTV Profit. You're watching Know Your Company, that is KYC. Let's understand what's on the list today, a JK Tyre. Why a JK Tyre? But before we get to that, I'm Hiral Datia and with me is Puneet Javeri. An interesting conversation, Puneet, this is going to be because very critical to understand what's happening with the tyre space, a beneficiary in terms of the GST reductions as well, and the kind of demand surge that people are anticipating. But first up, let's quickly take the quick questions as to what we will talk to the management about as well. The significance when it comes to the Chennai plant, specifically with regards to global exports, because this is one of the most crucial plants that they have. This is where they have incrementally been adding capacity as well, and the exposure it has to global markets. On number two, the key aspects in terms of international market growth and the aspirations that the company is sitting on. And very lastly, the acquisitions that the company is looking to make in the global markets.
Well, the other couple of key aspects on the conversation was on radialization. Now, that's essentially a key process where a lot of passenger car tires have already moved to this one. It's a process where the global markets are already radialized enough in the industry, and JK seems to be the pioneer in this because they were the first one to introduce radial tires back in 1999 and have been steadily increasing that. For trucks and buses, they're already at 66. And finally, in terms of the growth of the premium tires, and this one is key because that is going to be a big margin booster going forward as well. So these are the key 5 things that you need to watch out from the conversation with the management today.
Absolutely. But now let's tell the viewers what JK Tyre is all about. Part of the JK organization, the company was founded in 1951. It actually co-produced the first radial tire in 1977, and it's present in nearly 105 countries over almost 230 distributors. In fact, if you talk about the global distributors as well and this network that they have, it's a strong network of almost nearly 6,000 dealers that we're talking about, and 650 plus dedicated brand shops. In fact, overall, if you talk about the 11 globally benchmarked sustainable manufacturing facility is what the company has. In fact, it has 9 in India, 2 in Mexico, and they collectively produce nearly 35 million tires annually.
Well, the other one is about the plants, right? Because we specifically mentioned that 9 of them are in India. They are spread across the globe. We visited the Chennai plant, and we're going to get you some perspective from the shop floor. But apart from that as well, Uttarakhand as well as Karnataka are 2 key main geographies for the company. They have 3 plants each in these geographies. So they are expanding across north as well as the southern markets through these plants. The other one's Rajasthan, there where they have another plant. Madhya Pradesh is largely for the passenger car radial space, while Mexico, they had 3 plants earlier. They've closed down 1 just about 18 months ago, but still holding on to 2 plants. And this was another key plant because this is a key one to export to geographies like the US, and which is key for the tire maker. Similar strategy that what the other tire makers have also employed at this particular point of time.
Right. Now taking this into consideration, let's quickly understand the revenue mix of the company as well. 2 separate segments that we're talking about, replacement as well as OEM and exports. Now, clearly, if you talk about replacements, it has come down slightly, but has remained above that 60% mark. We're somewhere, sorry, it's gone up, I would say, from 61% to 64%. In terms of OEMs, that has remained stable, and your exports have seen a marginal downtick from 16% to 14%. But in terms of the replacement market, that becomes the key, and that is why you're talking about the revenue mix and the benefits of GST that could be coming in, especially when the replacement market picks up.
And they are a beneficiary directly for the GST rate cut, but also indirectly because through automobiles as well, which have seen a GST rate cut as well. So that's definitely one. The other aspect is on consolidated financial, and here you'll see that between FY24 and 25, the company did see a dip in its margins from roughly about 14% all the way down to 11.3%. And that's largely because of higher commodity costs. So natural rubber prices went through the roof in FY25, and they were a key impact because of that. Apart from that as well, you saw that across the industry where the growth was largely absent because of such high costs. So the companies had to absorb that particular point of time, and India is a natural rubber scarcity market roughly 40 to 45% of natural rubber is imported in the country, and hence we are a direct impact essentially of the commodity higher cost. So you said you did see that impact. Profits were also impacted because of that, but largely in terms of revenue, from FY23, it was a strong jump going into FY24, and hopefully, the company is hoping essentially that FY26 will be a similar growth trajectory.
Interesting numbers here, but let's quickly look at the rating parameters from here on. What are we going to talk about? First up, what we analyze is the income statement, balance sheet, cash flow and return ratios. These are the top 4 parameters that we will be considering. And post that, the shareholding, street credentials, valuation and the street coverage. All of this absolutely important 8 parameters that we're looking at. But Puneet, why don't you start with the income statement?
Well, largely, I did mention that, the natural rubber price impact was seen in FY25, and you did see the margins correct because of that. But, in terms of the 3-year CAGR performance, especially on the profits, we saw FY25 being largely a drag on the overall 3-year CAGR, but it still maintained a good 36% CAGR on profits, and hence we've given this a neutral rating, largely because of that aspect. Since the pandemic, the company has invested heavily in machines, they've invested in cost optimization, and therefore you're seeing almost the EBITDA CAGR being double of their revenue growth in this particular point of time. But a lot more work needs to be done, and since because of that aspect, as well as the recovery, while in Q1 we did see some key aspects of that, it is still something to watch out for. So hence we've given this a neutral because of that aspect. Quarter on quarter as well, you did see on a YY basis margins getting impacted, but a still better performance compared to what analysts had estimated. But we'll need some more evidence essentially of growth coming back in this year, and hence we've given this a neutral for now.
Okay. Let's look at the balance sheet. We have given the balance sheet a thumbs up. Now, if you talk about the equity, that's remained pretty much stable. In fact, their debt to equity ratio has somewhere improved marginally, so that is a positive. Their cash and bank, from almost a 266 odd crores, that actually nearly reached a 770, and that's where it's remained stable in that 770 kind of range in the last 2 years, which is again a strong one. Borrowings also somewhere that FY23 number has remained stable at FY25. And in terms of your other equity, that has seen a sharp improvement. So it's categorically telling you that the financials are improving when you're seeing that EBITDA base, which is improving. And secondly, when your cash and bank is remaining steady and improving. And third, your debt to equity, that has somewhere improved as well. So that again is another positive that we are tracking over here. And hence a thumbs up that comes in on the balance sheet front as well, Puneet.
Well, similar to the income statement, we have seen the cash flow also impacted in FY25. So when you look at the cash flow from operations to profit ratio, that fell to 45%. It was roughly around 94 in FY23, went to 77, and largely was expected to stabilize at that level. So we've given this a neutral as well, largely to see if that evidence does pan out of maintaining over a 70% cash flow to operations to profit ratio, and hence a neutral for now. The net cash flow did come back into the positive trajectory, but marginally of 15 crores, but still some evidence needed for the company. But definitely on the trajectory, it is expected, and the commentary by the management is positive to improve the cash flow from operations as well going into this year. Okay,
so that's a neutral rating coming in for cash flows. Let's look at the return ratios as well. Again, a neutral one coming in there because clearly FY24, they've seen a number as high as 19%. Currently in FY25, they're at around 13%. How soon will they be able to get to that 19% mark is the key question over here, and hence a pretty neutral rating is what we've given on the return on capital employed.
In terms of shareholding as well, Hiral, we have seen that the management has been able to maintain largely over a 50% share, while we would as investors like a lot more over 70%, but the company has mentioned that 51 seems to be what they are holding on to right now. Because of the reduction that we saw essentially in FY23 going into FY24, we did see the foreign investors largely enter the stock and have maintained that 16% share, while the public has continued and retail investors essentially have continued to show promise in the stock as well. So we've given this a thumbs up. Largely seems to be that both the domestic investors as well as foreign investors waiting for a turnaround in the stock as well as in terms of financials this year.
And if you talk about street credentials enough, because taking the retail investors into consideration, it has given good returns to them as well. In the last 1 month, 16% is the kind of up move that you've seen on a JK Tyre. Last 5 years, 6.6 times is the downtick that you've seen as well. But at least from a 1 month perspective, a good up move. 6 months as well. So the trajectory over the last 6 months has started pretty positively.
Yes, definitely. And, in terms of when you look at the valuations as well for JK Tyre and effectively in this particular point of time and, just a slight correction that it's actually been up 5.6 times over the last 5 years. So stock has, and largely it got impacted because of the pandemic. But there is one in terms of, the valuations priced attractively to say the least, because we have seen largely an absence of growth in FY25. Currently, the PE is roughly between 12.6 to 13 times price to earnings for 1 year forward in terms of valuations. And this is largely in line with what's happened in the 5-year term as well historically. So the street seems to be just waiting on the sidelines to see that the companies, the large measures that they've done actually result and come into the financials as well. So we've given this a thumbs up compared to peers which trade roughly between 18 to 22 times price to earnings. This does give the comfort of the absence of growth, and once growth comes back, you should start seeing that valuation perk up as well.
Valuation should perk up, but if you have to talk about the street credentials in terms of the coverage, 4 buy calls, 1 hold, an average upside of around 9%. So not major brokerages that are covering the counter right now, and hence a neutral rating.
And that largely seems to be, the key aspect, right? Because we have seen foreign investors holding it, but absence of brokerage in this particular time or point of time as well.
So whether you have further coverage that comes in initiations is what we need to see. But very quickly, in terms of your first 4 parameters, your income statement, cash flow, return ratios are a neutral. It's your balance sheet only, which is a thumbs up, which is a very good strength. Your shareholding, street credentials, valuation, again, a thumbs up. Your coverage is slightly neutral over here. So an overall 6 on 8, which is also a very good rating that we've given JK Tyre, Puneet.
And we are very stringent with the rating, so definitely key one aspect as well. But we did have a chance to speak to Mr. Anshuman Singhania. He's the managing director of JK Tyres, and we did visit the company at the shop floor in Chennai, a key factory which is almost 40% of his exports. Listen in to what he had to say. My first question largely about this facility, because it's almost 20% of the company's revenue, but very importantly, as you also mentioned to us, that it's almost 30 to 40% of exports that go from this one facility itself. Talk to us about the importance of the facility as well as the kind of technology investments that you've done over the last decade or so in this, which will lead to your international operations as well from the exports from this facility.
Sure. We have invested almost around 2,600 crores in this facility, and we are here making truck radial tires and passenger radial tires, which we are catering to the domestic and exporting as well. So here we are making a lot of premium range tires in the truck space and even in the passenger space, which we are serving in the domestic market. And here our premiumization has been one of the key drivers to enable us in terms of putting capacities. We are also having almost around 1,400 crores investments which are currently going on in our 2 locations, which will start ramping up from Q3 onwards. In terms of our markets in export, we are exporting to about 100 countries. We are exporting to UAE. We are exporting to Brazil, Latin America, Mexico, and also new markets in EU and UK. And we would be one of the largest exporter for truck radial tires from India in the EU and UK as we speak.
In terms of international operations, and we are actually seeing one of the major processes about this one as well in terms of truck radial tires. International operations has been one of the most focal points for all tire makers. Roughly for you, 16% comes from the export market. How do you see the medium-term trajectory of this? Because we are seeing one of the key on-sites of Europe demand coming back as well. Do you feel that going forward specifically, you will be one of the big beneficiaries of this, and with this new plant, a lot of that will be serviced with?
Yeah, with our capacities coming in stream, not only for the domestic market we'll be able to cater, but we'll be able to export as well. And as I said that our EU and UK are new markets, we are making a lot of development sizes for those markets. And there we are a very, very negligible player. So we will have a lot of headroom to, as we go forward, to play in those markets.
Specifically, one of the key aspects, in the early 2000s was acquisitions by the tire makers in international markets, both to gain technology as well as to gain capacity in those markets. You've also done that with Tornel in Mexico, and you have 2 facilities there operating as well. Talk to us a little bit about, your perspective of acquisitions, if any, in the future, because we seem to be that Indian tire makers seem to have grown leaps and bounds with technology so much, including yourself, that you all don't need to actually do another technologically enabled acquisition. How do you see that tire industry has evolved? And if you can talk to us about JK Tyres as well with that aspect, and what do you feel in the near future? Will it be brownfield capacity expansion similar to yours?
So look, in terms of our capacity increase, here we are equipped for a brownfield in all our locations for the time being. And international acquisitions are very tempting. We are always on a horizon to look at international acquisitions. As you said, that Tornel has been a very successful acquisition where we have turned around the whole company, Tornel Mexico. Here we are always looking out in the horizon for newer opportunities which come by.
But largely, would you say that you all don't actually need to do any acquisitions, which would be very, at least in the current market scenario, for absorption of technology? And India has, with yourself as well, in the tire space, done a lot of innovation enough now, so that, and we could drive that in the future?
You see, it's just not about the technology acquisition. It is also serving the market faster. We have been very successful in turning around acquired companies. We've acquired 3 companies, and we have turned it around in no time. So technology, yes, plays a very important role, but serving the market in terms of a ready facility with an upgradation also plays a very important role.
You were the first, pioneers essentially into radial tire space, launched back in 1999 for you all. And since then, now I think 2/3 of the market has become radial in terms of the trucks and buses. Do you expect that share will continue to grow substantially? And how does that, augur well in terms of the new investments that will be going in those for the international market as well? Do you think that for the international space, it will largely be the radial tires that will be getting absorbed as we see in the market?
Largely, well, I'll break this up into 2. One is the commercial, which is the truck tires, and the other one is the passenger car tires. In the passenger car tire, right now in the international market, it is almost become 98 to 99% radialized, and so is India. And but coming to the truck radial tires, right now we see that 56% is in India radialized, and rest is bias, non-radial. We have a feel that the bias is going to remain at a long run also. Long-term bias is going to remain because India still is a very price-sensitive market, and the applications in which the bias goes, namely mining application, even the construction application, their bias is still going to be staying. Well, in the international market, radialization in the truck space has happened more in America, more towards Europe. There are some pockets where truck bias tires are still at a play, where we are also participating.
You did mention about realization in America as well as in Europe, and I just want to pinpoint Europe for a bit because it's a huge market for the tire industries. What is your current share, if any? You can give us some perspective on Europe specifically. How much is your revenue in terms of percentage that comes from there? And do you expect that we'll start seeing a revival because that market has been depressed for almost the last 3 to 4 years? Do you expect that that will be the next growth engine coming back for the tire industry, and what would that be for you?
Yeah, so as I said that Europe is a new market for us. We will be certainly developing a lot of new sizes for the European market. And there I would say that we are a very, very small player in terms of the market share. And we would be definitely developing that. But from India to EU and from India to UK, we are one of the largest exporters in terms of truck radial tires.
So you should be seeing a big benefit because of the FTAs also, right? Which has now been coming in for...
Yeah, sure. The FTAs are also giving the Indian producers a good advantage over rest of the other countries here, and we will surely be taking advantage of that.
You mentioned about truck and bus radial because that's almost bread and butter, 50-55% of your revenue. But the passenger car space has also been very, very prominent for you. Over 30% of your revenue comes from there. We've seen, GST rate cut that will benefit all automobiles. Do you expect that that could grow faster? Because we are starting to see a lot of offshoots for the commercial vehicle space as well. So how do you see those in the current demand conditions for India specifically?
So I think GST has been a very welcoming move from the government, and GST brings in a lot of cash in hand for the consumer. And the consumer-facing goods like passenger car tires, the 2-3-wheeler tires, and even the farm tires will definitely see a good positive flip as we go along. And even in the commercial vehicle, there will be lot of movement, and we measure it by BTKM, which is billion ton per kilometer, and there we have seen there is a sharp increase in terms of percentage, which is an indicator of freight movement. And with this GST, I think there will be a lot of movement amongst our major highways with our large and small and medium transporters. So there is a lot of positive growth coming in from there.
So that's the management, in conversation with Puneet as well. But clearly, Puneet, the company has indicated they're very small in the European market, and that's what they want to develop, a big beneficiary of trucks and bus exports from Europe, to exports to Europe from India. So that's the business that investors should be looking at as well. But completely out of time. But that's it, it's a wrap on this edition of Know Your Company. Lots more lined up on the other side. Please stay tuned to NDTV Profit.